Imagine locking your future into a contract that pays you every year for 3 decades. Now imagine the rules change the week after you sign. The rate moves, your payoff shifts, your plan bends. This is the reality of money. It's not just about what you plan, it's about how the world decides to play. Rates move, currencies wobble, crowds cheer one day and panic the next. Most people think that means chaos, but if you understand the patterns, it means opportunity. Stay with me. The map is clear. The path is the passive path. You will learn how rate cuts and bond yields really move together. Why long bonds can bleed right after a cut. Who is buying US debt today and why that matters for your future. When short bonds make sense and when they don't. How to build a simple plan for 3 very different interest rate paths and a 7-day checklist you can act on right now. Before we dive into the plan, let's lock in the main lessons from today's story. Rate cuts don't guarantee falling Treasury yields. Last year, yields ran higher after cuts, and popular bond ETFs dropped hard. The market often moves before the Fed. Short-term Treasury yields soften first, then the Fed follows. Global demand matters. China sold Treasuries in recent years. Japan and the UK stepped in as key buyers. This link means stress in one country can spread into others. Currency risk is the quiet thief. If your home money rises against the dollar, your safe return can flip negative. Tactics from the story point towards short-term bonds only if 2-year yields break below 3.5%. With the next zone near 2.5%, long bonds carry far more risk if yields pop higher. And the biggest lesson of all, process over prediction. Treat price like a fire alarm. Don't argue with smoke. Move when the signal shows. If the market leads the Fed, who is really in charge? E-Crowd says the Fed sets rates. The tape says money flow sets the stage. When demand for treasuries jumps, short yields sink. The Fed then follows the path that the market has already cleared. This is why the real story begins with buyers. Who buys? Who sells? And why? Think of it like a market full of chairs. Every bond is a chair. Every buyer is a guest. When the room fills fast, the chairs run out and yields fall. When guests leave, empty chairs rise and yields climb. A retiree in Texas once tried to follow every Fed headline. She watched hours of cable news. She argued with friends about what Powell would do next. Her portfolio went nowhere. Then she changed her approach. One rule only. Watch the 2-year yield each Friday. If it broke below a key line, she shifted a slice of cash into 2-year treasuries. No guessing, no drama, better sleep. Money flow moves first, policy follows. If money flow leads, then the next question is clear. What happens when the cut comes and pain follows anyway? Last year proved a painful point. The Fed cut rates. Many expected a bond rally. Instead, long yields spiked. Popular bond ETFs dropped by nearly a quarter from their highs. This is the trap. Cuts don't always equal gains. Sometimes they mark the start of more hurt. Why does it happen? Because cuts arrive when trouble is already in the air. Growth hopes may still linger. Supply fears still weigh on long bonds. Investors demand higher yields to hold the risk. Translation, a rate cut is not a green light. It can be the exact opposite. Picture an investor with $1 million. She placed it in a long bond ETF right before the first cut. She thought it was safe. When yields rose, her account bled like a stock portfolio. She held on, hoping for a bounce. The bounce never came. Pain leaves marks. The lesson is clear. Timing matters. Tenor matters. If long bonds can hurt after cuts, then who ends up holding the bag? The shelf that holds U.S. debt is global. China reduced its holdings. Japan and the United Kingdom stepped in as major buyers. This shift creates a chain. When one link shakes, the others rattle. If the UK faces stress, its bond market can spill pressure into U.S. treasuries. If Japan adjusts policy, the ripple touches American yields. Think of boats tied together in a harbor. If one catches fire, the flames spread across the ropes. No boat is truly alone. Treasuries are not an island. They sit on a shelf built by global demand. And when the shelf wobbles, your returns wobble too. With the shelf in view, the next step is to mark the levels that matter most. Blue lines keep showing up. They guide timing. They shape decisions. On the long end, the 30-year yield has pressed against a roof near 5%. Buyers appeared when it dipped toward 4.7%. That zone acts like a soft floor, not a promise, but a signpost. On the short end, the 2-year yield hovers near 3.5%. That level is support. If it breaks lower, space opens toward 2.5%. If it bounces, it warns that cuts may stall. These numbers are not magic. They are markers. They tell us when to step forward and when to pause. The plan is not to assume. The plan is to react. With levels in place, the next step is to build a playbook that anyone can run without guessing. Think of the plan as 3 tiers. Each tier unlocks only when the signals appear. Tier A is cash and very short bills, 0 to 6 months. This is the base position while the 2-year yield hovers around 3.5% and keeps bouncing. The target here is liquidity first, income second. Tier B is 1 to 2-year treasuries. The trigger is a 2-year yield that closes below 3.5% for 2 full weeks. The move is to add in steps, never all at once. Trim exposure if the yield rises back above 3.5%. Tier C is 5 to 10-year note. The trigger is a clear downtrend in the 2-year combined with a lower high in the 10-year. The entry is in thirds, spread across weeks. The rule is to set an exit before entry, whether by yield stop or time stop. No exposure to long 20-30-year bonds unless both short and mid triggers align and the curve calms. Income is nice, but there is another thief waiting in silence. Currency can steal it. Currency risk is the quiet thief. If your home currency rises against the dollar, your bond income can disappear. The coupon you earned in dollars may shrink or even turn negative once converted back. An investor in London once bought treasuries for steady income. The bonds paid as promised, but the pound rose. Her gains in dollars shrank into losses in pounds. There are tools to guard against this. You can hold local currency bills. You can hedge a slice of your exposure. You can stagger your buys across time. You can earn in the same currency you plan to spend. A nurse in Toronto faced this same leak. She bought 2-year treasuries for yield. When the Canadian dollar rose, her return shrank. She shifted to a split, half in Canadian bills, half in U.S. bonds with a hedge. Her net return steady. If you must hold U.S. treasuries, size them like a risk asset, not like a savings account. With the currency thief exposed, the next step is to look ahead at 3 possible paths and what to do in each. There are 3 clear paths for the next 12 months. Each demands a different response. Scenario 1 is slow drip cuts. The 2-year yield grinds down, then stalls. The play is Tier B, 1 to 2-year treasuries. Add on dips in yield. Avoid long bonds until the 10-year prints 2 lower highs. Scenario 2 is a sharp break lower in short yields. The 2-year slices through 3.5% and trends toward 2.5%. The move is to scale into Tier B quickly, then stair-step into Tier C. Keep hedges in place against currency swings. Scenario 3 is yield curve control or the rise of a heavy buyer. If a central bank or large fund caps yields, bond prices can jump. But currencies often weaken under the weight of this support. Long bonds can rally fast, then collapse just as quickly. Treat them as trades, not marriages. Raise cash if your home currency strengthens against the dollar for 2 months in a row. Bonds are only one lane. You need more than one engine to move forward. When easing begins, it often lifts more than bonds. Other assets can benefit too, if chosen with care. Quality stocks with strong balance sheets tend to hold their ground. Cash flow real assets like rental properties that can reprice often keep up with inflation. Short duration credit can pay you when spreads are wide enough. A small trend following sleeve can catch momentum when markets turn. Guardrails matter more than picks. Never take hero shots. Buy in thirds to spread risk. Cut losers quickly instead of waiting for hope. Write the exit plan before you buy. Bonds and assets can move in your favor, but all of it fails if the mind slips at the worst moment. The most important rule is process over prediction. Price is the fire alarm. You do not debate the smoke. You move when the signal comes. Pre-commit to the steps. If the 2-year yield closes above 3.5% for 2 weeks, pause new bond buys. If the 10-year yield makes a higher high, avoid adding long exposure. If your home currency rises 5% against the dollar, cut your U.S. bond size. Turn maybes into checkboxes. Turn opinions into rules. This is how discipline holds when emotions rise. Stories make rules stick. Here are 3 that show the difference. The first story is the early buyer. He bought long bonds the moment he heard about rate cuts. Prices dropped, losses piled up. He held on, hoping for a rebound that never came. A time-based exit rule would have saved him. The second story is the FX leak. An investor earned 4% in coupons, but the exchange rate moved against him. The gain disappeared. A split between local currency bills and hedged bonds kept future returns stable. The third story is the paycheck ladder. An engineer built a 12-month ladder of Treasury bills. Each month, one rung matured. He reinvested it at the back of the ladder. Cash kept flowing. His sleep improved. So did his confidence. Clear rules, simple structures, and repeatable habits turn noise into calm. Now it's time to see what these rules look like inside real portfolios. MK of 3 portfolio shells you can copy. Each one balances bonds, stocks, and real assets in a different way. The conservative shell is steady and defensive. 60% in bills and short notes, 25% in quality stocks, 10% in real assets, 5% in a small trend sleeve. The balanced shell spreads the load, 40% in bills and short notes, 35% in quality stocks, 20% in real assets, 5% in a trend sleeve. The growth tilt shell leans forward, 25% in bills and short notes, 50% in quality stocks, 20% in real assets, 5% in a trend sleeve. Rebalance once per quarter or whenever any slice drifts more than 5 percentage points from its target. Plans are just words until they touch a calendar. That's where the 7-day action plan begins. Day 1 is about currency. Write down your home currency, write down the currency where you spend, decide if you must hedge. Day 2 is about yields. Check the 2-year and 10-year charts. Mark 3.5% and 2.5% on the 2-year. Mark the last high on the 10-year. Day 3 is about templates. Pick your shell, set your maximum size for long bonds. Most will start with 0. Day 4 is about structure. Build a 3-month Treasury bill ladder. Small, even rungs. Cash rolls forward each month. Day 5 is about exits. Write your exit rules on paper. Yield stops. Time stops. Currency stops. Day 6 is about accountability. Share your plan with one other person. Promises made in public are harder to break. Day 7 is about review. Check your home currency against the dollar. If it has risen, cut your US bond size by the amount you wrote on day 5. Routines like these stick when they are light and easy. That is why millionaire routines look simple. Millionaire routines are not built on brilliance. They are built on rhythm. A Friday yield check. Close the week by looking at the 2-year and the 10-year. One glance, one note. A weekly cash review. Decide once how much moves into bills or bonds. No second guessing until next week. A monthly ladder roll. When one bill matures, place the cash at the back of the ladder. The wheel keeps turning. A quarterly rebalance. Shift slices back to their targets. Do it on schedule, not on impulse. These routines are light. They reduce stress. They build consistency. We have come full circle. It is time to bring the lessons home. Do not buy headlines. Buy rules. Long bonds can fall even after rate cuts. The market leads while the Fed follows. Short bonds are a tactic, not a crutch. Currency can erase your gains if left unchecked. Take small steps. Set clear exits. Protect your sleep as much as your portfolio. If this gave you value, press like. Subscribe to The Passive Path to keep building your plan. Share your favorite rule in the comments. One sentence is enough to make it yours. We will stack 2 signals that spot trend changes earlier and with fewer false starts in future videos. Until then, I wish you luck as you build your path forward. Feel free to watch the other videos on this channel to keep learning and growing. I'll see you in the next video.